Foreign investors' selling of Chinese shares gained some momentum in May, as flagging domestic demand and expectations for weak corporate earnings led to steep falls on mainland and Hong Kong stock market. Refinitiv data shows foreigners sold $1.71 billion worth of mainland shares this month via Stock Connect, a key cross-border link between the mainland and Hong Kong exchanges, after selling $659 million in April. The selling marks a slow reversal of their heavy investment totaling $20.92 billion in January when China reopened its economy after 3 years of COVID restrictions, spurring a wave of bullish expectations for growth. Such hopes were dashed as domestic and overseas demand wilted, and the recovery proved uneven. According to data from the National Bureau of Statistics, profits at China's industrial firms slumped in the first 4 months of the year. Despite outflows in February, April, and May, foreigners' net purchases of mainland shares still stood at $25.5 billion for the first 5 months of this year, compared with net buying of about $6.36 billion worth over the whole of 2022. In April, imports contracted sharply, factory gate prices fell, property investments slumped, industrial profits plunged, and factory output and retail sales both missed forecasts. Over the past month, analysts have cut their forward 12-month earnings forecasts of China's large and mid-cap companies by over 0.7%, with mining and real estate sectors seeing over 3% cuts. Investors are fleeing China due to the country's unpredictable policymaking, which is deterring foreign investment that the country's cash-strapped cities are desperate to entice them. Local officials are making efforts to attract foreign entrepreneurs through cold calling and road shows overseas to bolster coffers depleted by years of pandemic spending and a cratering property market. However, these efforts are being met with a lukewarm reception from business communities outside China. The appetite for investment has been further weakened by a clampdown on foreign consultancy firms, which has been relied upon by global investors and multinational firms to help understand China. This campaign follows a series of abrupt regulatory tightenings on industries ranging from technology to real estate that sent foreign capital fleeing from the nation's financial markets. Investor confidence is probably at the lowest it's been. Over the past few months, dozens of Chinese provinces and cities have sent delegates to host investment roadshows in countries including Singapore, Japan, France, Germany, as well as nations in the Middle East. Shanghai alone plans at least 100 overseas visits this year to attract business, while the southern province of Guangdong wants to lure at least 2 trillion yuan, or $288 billion in foreign investment over the next 5 years. However, businesses are holding fire on increasing investment in China because of concerns like the crackdown on foreign consultancy firms. Foreign direct investment in China plummeted in the second half of last year as corporate profits declined and the economy struggled due to COVID-0 lockdowns. Global investors have lost interest in Chinese equities, with the MSCI China Index dropping about 50% from its 2021 peak. Foreign holdings of Chinese bonds fell for 12 of the 13 months through February, before rising slightly in March. In response, the Politburo last month called on local governments to boost foreign investment amid weak domestic demand and a difficult recovery. China's local governments face a tough task. Their spending rose 2.6% last year to pay for the cost of COVID controls, tax cuts, and other programs, while income declined 11% due mainly to a slump in land sales caused by the downturn in the property market. Debt costs are rising after they increased borrowing in recent years to pay for infrastructure investment and fill budget gaps. Rising tensions with the West are adding to the challenge. The majority of United States firms that are already invested in China have said the country isn't a top 3 priority anymore, while the United States government is looking to limit some investment flows to China. In conclusion, China's unpredictable policymaking, clampdown on foreign consultancy firms, and a downturn in the property market have resulted in a decline in foreign investment. The efforts of local governments to attract foreign entrepreneurs are being met with a lukewarm reception from business communities outside China. The rising tensions with the West are adding to the challenge. According to an unnamed official, Singapore has seen delegations from Chinese cities almost every week this year, and officials have started cold calling overseas companies, skipping small talk and asking directly for investment, a tactic that was rare before the pandemic. However, interest in investing in China is hard to find due to geopolitical tensions and concerns about hidden debts. The mayor of Qingdao held an event in Tokyo in April for more than 300 people, but no details were announced of any deals or monetary investment. Although almost every Taiwanese business association in mainland China has been asked to increase investment this year, new investment from Taiwan Taiwan's firms fell 10% in the first quarter, and Taiwanese bank exposure to China dropped to a record low at the end of March. Even businesses that do invest are taking a cautious approach, preferring to focus on their own operations in China instead of direct cash investment, due to the erosion of trust in the Chinese government and its current business environment. Thank you for watching this video to the end. Subscribe to the channel and write your opinion in the comments.